The Nasdaq now down into that correction territory, and people wondering if this is the end of the pain or if there's more to come. What do you think?
I think there's more to come. I certainly wouldn't be surprised Nasdaq to go into bear market territory, and the S&P, because it is top heavy with tech, probably go into deep correction territory. As you know, I've been saying that inflation is much worse than the Fed admits. Even now that they're way behind the curve, they've got to catch up. I said last year that it's not going to be 4 increases, it's going to be 8 increases. The Fed funds rate is going to probably be at 2% by year end. That market has not completely digested that yet. So I think there's more pain to come. And I think clearly on Wednesday, I think we're going to hear a much more hawkish Jay Powell than we have in the past.
So if you're talking about getting the Nasdaq down into bear market territory and the S&P well into correction territory, you're talking about the losses more than doubling from what we saw last week. That's some pretty significant declines. How quickly do you think that will happen?
Well, I think it's very hard to predict. To say that the Nasdaq is in correction territory, it has to go down maybe 10%, maybe 15%. I think that would not be unusual. I mean, there's two problems with the tech sector. One is the interest rates, which I think is going to surprise them on the upside. And then their earnings have to hold up. And what we saw with Netflix, if there's any disappointment, we see the reaction there. So they've got to meet optimistic earnings projections, and they've got to have not too hawkish a Fed. Now, I think on the latter, they're going to be disappointed. It would really be bad for them if we see any faltering of those earnings. And I'm not saying that's going to happen yet, but they have two challenges that they have to meet that the other stocks don't. I think the rotation is going to continue. Finally, we're going to see those value stocks outperform the growth stocks. I mean, it's been a violent change over the last 20 days, but I don't think it's over. It still isn't the change that we saw from October of 2020 all the way to March of 2021. We actually saw a bigger rotation, then it went all the way back. Now we're starting again. I think that this is going to be one that's going to be deeper than what we saw before.
With your expectations for declines like that, that really puts investors in a bit of a conundrum because, the reason the Fed is going to have to raise rates is because inflation is so high. If you're talking about inflation that's 7% on an annualized basis or maybe even north of that, your money becomes less valuable. If you've got $1, it's worth 93 cents a year later. You can't just stick it in a bank account where you're getting 0 interest rates and think that it's safe. You can't stick it under your mattress, let's say. You're going to be losing money if you do that too. So what would you be telling people to do right now? Where should they put their money?
I don't play short-term fluctuations. I would say I would wait if I had cash to deploy, and I would underweight those technology stocks that, I'm not talking necessarily the Apples and those that are I'm talking about all the others. The rotations, I mean, Jim Cramer's been talking about this a long time. I've been talking about that. I would prune those that are on the more speculative side, push towards those that are more on the value side, that are earning, that are giving dividends. You're right. You're going to lose in cash, but you're probably going to lose more in bonds. I think the bond rate is going above 2%, so that is going to be even worse. In a process where discount rates rise, and in an inflationary process, there's really very little that you can do in that short run. In the longer run, I still think the S&P is a very good chance to be up this year by the third and fourth quarter. But I think the next 6 months are going to be tough for the market.